Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
So imagine you're running a business, right? And you manage to sell like 5% more of your core product.
Okay, sounds like a good quarter.
Right. You're selling more stuff to billions of consumers globally.
Mm-hmm.
But then you look at the books and you discover you actually made 17% less money for all that extra effort.
Oh, wow. Yeah, that's a brutal realization.
It's completely wild. It's a total mathematical paradox.
Okay.
But that is exactly what the Coca-Cola company ran into in their Asia-Pacific market this quarter.
Yeah, and what's fascinating is that simultaneously, the overarching company somehow managed to grow its total net revenues by 12%.
Wait, 12% overall?
Yeah, hitting a staggering $12.5 billion in just 3 months. So
Yeah.
you have this massive structural juxtaposition.
I mean, $12.5 billion in 3 months, that's just, I can't even wrap my head around that scale.
It is huge. On one hand, you have this localized margin compression in Asia where, moving more volume actively hurts the bottom line. But on the other hand, you're seeing this incredibly resilient global pricing power driving just record-breaking profits everywhere else in their portfolio.
Okay, let's unpack this, because we're diving into Coca-Cola's Q1 2026 earnings report today. And it isn't just about tallying up revenue columns.
No, not at all.
It's honestly a masterclass in consumer psychology, revenue growth management, and frankly, the brutal reality of global supply chains.
Absolutely.
So to you listening, our mission today is to look way beyond that $12.5 billion headline. We want to figure out the actual ground-level mechanics of how a 100-plus-year-old legacy brand operates at this kind of scale today.
Yeah, because those headline numbers definitely paint this picture of, total invincibility.
For sure. I mean, $12.5 billion.
Right, and we're looking at 10% organic revenue growth, operating margins expanding to 35%, which is up from 32.9% last year, by the way.
Which is a huge jump for a company that size.
Exactly, and their earnings per share jumped 18% to 91 cents.
Okay.
But to truly understand the operational reality of this quarter, we have to talk about a structural anomaly that's kind of hidden in the fine print.
Okay, yes. I am so glad you brought this up, because before we just crown them absolute marketing geniuses for that $12.5 billion, let's talk about the calendar.
Ah, yes. The calendar shift.
Because I saw this in the report and I had to read it twice. Their concentrate sales were 5 points ahead of their unit case volume.
Right.
And the main reason for that, the first quarter of 2026 literally had 6 additional days compared to Q1 of 2025.
It's a huge factor.
I mean, let's be real here. It's like a retailer bragging about this massive boost in weekly sales, and then they quietly admit, oh yeah, our week was actually 8 days long.
Yeah, that is a perfect analogy. The ripple effect of those extra 6 days is undeniable.
Right.
You're basically baking almost a full extra week of global consumption into a single quarterly report.
So it's a bit of an illusion.
Well, partially. The company does note that this volume bump was offset a bit by the timing of concentrate shipments. So, it isn't a pure one-to-one windfall.
Okay, so they can't just blame all their success on a longer quarter.
Exactly. You can't chalk up a 12% net revenue jump just to having a few extra days. The real secret weapon, the more critical lever they pulled, is this 2% growth in their price mix metric.
Okay, price mix. This is where the inflation battle is actually being fought, right?
You nailed it.
Because they didn't just sell more liquid to bottlers. They actively flexed their pricing power. They pushed higher margin items, or they shifted volume into premium channels to offset all those higher input costs.
Yeah, because Coca-Cola is dealing with the exact same higher input costs as every other manufacturer right now.
Right, like commodities, transportation, labor.
Exactly. Everything is more expensive. But by flexing that pricing power and optimizing their mix, they successfully protected and actually expanded those margins to 35%. But it's a super delicate balance, pushing the price just high enough to cover costs without making the consumer just walk away or buy a generic brand.
See, that's what gets me. You can't just algorithmically raise prices and expect people to keep buying a discretionary soda without any friction.
No, people will definitely notice.
Right. Consumers have to feel a deep emotional connection to the product, something that kind of overrides that logical hesitation when they see a higher price tag.
And that emotional connection is exactly what their CEO, Henrik Braun, was talking about. He highlighted their focus on, quote, staying close to the consumer.
Okay, but what does that actually mean in practice?
Well, it means they've moved away from those homogenized, one-size-fits-all global broadcast ads.
Oh, I see.
Yeah, instead, their whole strategy relies on what they call locally relevant marketing at scale.
Okay, locally relevant marketing at scale. Let's dig into that, because doing that globally seems functionally impossible.
It's definitely an undertaking. Let's look at China, for example. For Chinese New Year, they didn't just run a generic Happy Holidays TV spot. They built an AI-enabled campaign inspired by traditional Chinese paper art.
Wait, really? Paper art?
Yeah, consumers could scan connected packaging to generate highly personalized digital family portraits. It totally bypasses generic corporate messaging and embeds the brand right into a deeply cultural moment.
Oh, wow. So it's not a faceless brand, it's part of the family gathering.
Exactly. And then look at how they pivot for markets observing Ramadan. The insight shifts entirely to generosity and shared meals.
Right, totally different vibe.
Completely. In Turkey, they ran a digitally led recipe campaign that drove chef-led food donations. In Egypt, they literally set a Guinness World Record for the most community meals served in 1 hour.
A Guinness World Record. That is insane.
And in Indonesia, they positioned Fanta specifically around Ramadan night celebrations.
Okay, the logistics of managing all of that from a centralized corporate headquarters in Atlanta, it just seems impossible.
It would be if Atlanta did it all themselves.
It's like a massive touring stadium band, right?
Yeah.
And they take the time to learn this obscure, hyper-local folk song for every single city they visit.
Yes, exactly.
The only way giant corporation could pull that off without feeling super inauthentic is if they aren't the ones actually pulling the strings locally.
That is the magic of their franchise bottling model. That's the engine making all this local intimacy possible.
Ah, the bottlers.
Right. Atlanta provides the brand architecture, the overarching strategy, the capital, but the local bottlers and regional marketing teams, they're the ones executing it.
Because they actually live there?
Exactly. They know that a Brazilian carnival activation for Sprite driving double-digit growth requires a totally different tone than, say, Coca-Cola and Body Armor dominating U.S. March Madness.
Oh, definitely. March Madness is a whole different animal.
They called that campaign Fan Work is Thirsty Work. It's brilliant, but it only works in the U.S.
So by empowering the local operators, they strip away that perception of being this, multinational monolith. They turn a global commodity into a local community staple.
Which is how you get people to keep buying it even when prices go up.
Right, but an emotional connection only gets the consumer to walk down the beverage aisle, right? To actually maximize the revenue of that visit, you have to manipulate the physical product they pick up.
And that brings us to the psychology of packaging, or what they call revenue growth management, RGM.
Okay, RGM. So it's not just about the liquid in the can, it's the can itself.
Exactly. It's optimizing the brand, the price, the package, and the channel to maximize financial value for every single transaction occasion.
Here is where it gets really interesting to me. The physical packaging is where this whole price mix strategy becomes tangible for the listener.
Oh, absolutely. Look at North America.
Yeah, let's talk about the mini cans.
The volume of single-serve mini cans is growing by high single digits, mostly driven by convenience stores.
Right, and if you think about it, a consumer grabbing a mini can is essentially paying a massive premium per ounce compared to buying a standard 2-liter bottle.
It operates on the exact same psychological trick as buying travel-size shampoo at a pharmacy.
Oh my gosh, yes.
You happily pay a 400% markup per ounce because you aren't really buying the volume of the product. You're paying for the convenience, the specific portion control, the context.
Right, it's a financial Tetris game. They're fitting the exact right size to the right price for your specific mood. The mini can captures the person who just wants a quick, permissible treat.
And they do not care about the unit economics of that purchase.
Not at all. Meanwhile, in the UK, they launched a premium 500 milliliter superfan can with Premier League soccer themes.
Yeah, that's a totally different play.
They're getting a premium there, not for convenience, but for tribal affinity. Right. Collectability.
Exactly. And then in developing markets, the strategy flips entirely. In the Philippines, they drove double-digit growth for single-serve Coke Zero Sugar packs by focusing purely on affordability.
So getting new consumers into the ecosystem.
Right. And in Thailand, they bundled at-home packages with collectible glassware to drive volume in supermarkets.
Even their sustainability stuff is tied to profits, isn't it?
Oh, 100%. They are expanding the use of ultra-lightweight bottles in South Africa and India.
Which sounds great for the environment.
And it is. It plays very well for environmental goals. But from an earnings perspective, Slashing plastic use drastically reduces raw input costs and transportation weight.
Wow, so it directly supports profitable volume growth in those specific markets.
Yes. By deploying this massive spectrum of packaging from premium collectible cans in the UK to ultra-lightweight value bottles in India, they capture every demographic.
Every wallet size.
Every single consumption occasion. So when that local marketing gets you to the shelf, there is a package engineered perfectly for your mindset in that exact second.
Okay, so if the packaging is steering consumers so effectively, how is that impacting what liquids they actually choose to drink? Because the data shows a pretty big divide in their product portfolio.
Oh, huge. The undeniable star player right now is Coca-Cola Zero Sugar.
It's everywhere.
It grew 13% globally across all operating segments.
13%? Wow.
Just to put that in perspective, traditional trademark Coca-Cola, the classic red, can only grow by 2%.
Okay, so that is a massive structural shift towards zero sugar alternatives. But it's keeping those consumers inside the Coke ecosystem.
Exactly. They aren't losing them to water, they're just shifting them to a different Coke product.
But wait, the juice, value-added dairy, and plant-based beverage category actually declined by 1%.
Yeah, it did take a hit.
Does that mean people are stopping buying brands like Fairlife?
No, actually. The report clarifies this wasn't a failure of consumer demand. Brands like Fairlife actually grew. The decline was heavily impacted by a divestiture.
The Nigeria thing.
Right. They sold off their finished product operations in Nigeria in late 2025. So that artificially dragged down the global volume numbers for that specific category.
Got it. So that divestiture kind of distorts the balance sheet a bit.
It does.
But I want to go back to the most revealing structural shift in this whole report, the thing we talked about right at the start.
The Asia-Pacific paradox.
Yes, the Asia-Pacific paradox. Let's dissect this. They grew unit case volume by 5% across the region. So people are physically drinking more product.
Right.
But their comparable currency-neutral operating income plummeted by 17%.
It's a brutal drop.
If profits are cratering while volume is rising, they must have heavily slashed prices, right? Or aggressively shifted to low-margin products just to keep cash-strapped consumers buying.
That is exactly the mechanism. They faced a 6% drop in price mix in the region.
Ouch.
Yeah, they were running these aggressive affordability initiatives to maintain consumer engagement because the macroeconomic environment there is highly pressurized right now.
So they lowered the barrier to entry.
Right. But when you combine that lower revenue per unit with higher localized input costs and sustained marketing investments, your margins just compress violently.
You're moving millions more boxes out of the warehouse, but making significantly less money on every single one.
Exactly. It's the ultimate proof that volume is purely a vanity metric if the underlying unit economics don't hold up.
Which is wild to think about.
And you can contrast that Asia-Pacific reality directly with their bottling investments segment.
Oh, right. How did that segment do?
Well, unit case volume there barely ticked up, just 1%.
Barely moved.
Barely moved. But their comparable currency-neutral operating incomes skyrocketed by 53%.
Wait, 53% profit growth on 1% volume growth?
Yes. It is a masterclass in operational discipline. That profit spike was driven by ruthless cost management, refranchising specific bottling operations, and really targeted organic revenue growth.
So it's the exact opposite of the Asia-Pacific situation.
The complete antithesis. Controlling operating costs and optimizing the franchise structure yielded exponentially more profit than just chasing sheer volume.
That is such a crucial lesson. Unchecked volume can literally erode your business if the discipline isn't there.
Absolutely.
So looking ahead, Coca-Cola seems highly confident they can maintain this discipline across the rest of the enterprise. They're actually maintaining their guidance of 4 to 5% organic revenue growth for the full year of 2026.
And the scale of the capital they're generating to execute that strategy is just staggering.
Yeah, hit us with the projections.
They are projecting approximately $12.2 billion in free cash flow this year.
$12.2 billion in free cash.
Yeah, that derives from $14.4 billion in operations minus $2.2 billion in capital expenditures.
That is an unbelievable amount of liquidity.
It is. And they're also anticipating the second half sale of Coca-Cola Beverages Africa, or CCBA.
Okay, so they're continually shifting their global footprint.
Exactly. They are divesting these capital-intensive operations to free up even more cash, and then they reinvest that cash into brand building and those hyper-targeted revenue growth strategies we talked about.
So what does this all actually mean for you listening to this? We started this deep dive trying to understand how a legacy brand engineers a $12.5 billion quarter in just 3 months.
And the answer is pretty counterintuitive.
It really is. What we found is that they don't actually operate as one unified global brand at all. They operate as hundreds of hyperlocal, decentralized entities.
Armed with deeply psychological packaging.
Right. And pricing architecture is designed to extract maximum value from every single interaction. They have perfected the illusion of local intimacy at a massive, industrialized global scale.
It's a brilliantly executed illusion.
But I want to leave you with a provocative thought today to kind of mull over.
Oh, I like where this is going.
This entire record-breaking strategy relies on hyperfragmentation,
Yeah.
right? Customizing the package, the price point, the marketing to every individual region and demographic.
Down to the neighborhood convenience store.
Exactly. But as climate change accelerates and global supply chains face increasingly unpredictable disruptions, the luxury of producing 100 different ultra-lightweight bottles in hyperlocal formulations, that might become mathematically impossible.
That is a really sharp point. The supply chain complexity is immense.
Right. So if extreme weather events and resource scarcity force these multinational companies to retreat back to a single, homogenized global supply chain just to survive, what happens to that carefully crafted illusion of local intimacy?
Wow. Yeah. If those operational constraints tighten, the hyper-personalized choice architecture we just spent 20 minutes dissecting might look entirely different a decade from now. Or it might just disappear.
Do we lose the local connection entirely? Or does the definition of a global brand simply have to evolve all over again? It's something to think about the next time you grab a mini can.
Definitely.
Keep questioning the hidden systems and the structural choices behind the everyday products around you. Thanks for listening, and we'll catch you on the next deep dive.